Stephen Thomas going live, a little bit late. Sorry for the little bit of a delay. I'm actually remote. I'm at a remote secret location, which I cannot disclose where I am at. But let's see, I want to go ahead and start this presentation. So thank you for joining me, the Other Housing Debrief. And this is the 18th debrief of the year. And really excited to bring you the latest and greatest. And it's been quite a whirlwind tour. A lot going on, a lot of changes in the housing market, and been out in the offices and different company meetings, different people out there trying to get the latest and as to how the market is evolving, so that they can properly explain it to clients, so we can set expectations. And that's what it's about. I'm a housing analyst. I'm with Reports on Housing. And but let's get into this housing debrief. First, I invite everybody to go to Reports on Housing on YouTube. That's the handle, Reports on Housing on YouTube, and like the videos, and please subscribe. The more subscribers we get, the more people's eyeballs get to actually watch good content. So, and it's not a pat on my back. I just want everybody to know that there's a lot of people feeding misinformation out there, and they do not have the credentials to back it up. They do not have an economic model that they're following. That's all that I do. I look at these economic models, and I can see where we've been, and I've seen these playbooks. I said what it was going to take to slow down this market, and that's higher rates. We got higher rates, and sure enough, that's exactly what we're experiencing right now. So please like and subscribe. Go to Reports on Housing on YouTube. Of course, we're going to start off with something funny. Please do not fill up your gas tank until after we close on your home. Now, lenders used to say, and they still do say, don't do any big purchases like furniture or a car. And I guess this is for a tank of gas, that's considered a big purchase now. How about this one? The face you make when you're waiting on an appraisal, right? Is this gonna appraise? I sure hope so. Can't wait for this thing to go through. So housing is rapidly cooling, and that's exactly what's going on. As a matter of fact, within the last couple weeks, there's been a real sea change in how the market has been evolving. Even over the last week, it's been quite the evolution, a big giant change. And we started off this year with a very empty gas tank where there were no homes on the market. I have never seen the market get down to this few, this low of a level of homes on the market. There just were not enough homes. And you can see this was my very first report that I did at the start of February for the housing debrief. And I'm going to point to it right there. And it was the lowest level ever, which was a little bit to the left. That was 10,853 homes for all of Southern California. Now, keep in mind, for Los Angeles County alone, their 3-year average prior to the pandemic is closer to the 12,000 homes in the market right now. And for all of Southern California, we had less than that. Not even 11,000 homes. And that's where we started off this year. And that's where interest rates started to go up, but we still had a big giant frenzy where you have nothing on the market. So everything was blowing out the market rapidly for way over the asking price because there was nothing available. Something came on, even if it backed up to a busy street or it wasn't in good condition, everybody pounced on it because that was the beginning of our year. But it has since evolved, and this is mortgage rates so far this year and how much that they have gone up. And as you can see, compare this to all these other years that date all the way back to 2011, this is how much the interest rates changed over time. And you can see interest rates have definitely changed over time, like we have not seen in a very long time. And this is why we're seeing such a significant change. We actually did have a change in interest rates in 2013. That's the light green line. You could see that. That's up towards the top. And then also we had that in 2018, which was the dark blue line, which is right below 2013. So you could see it over here. This is 2022, this is 2013, and this is 2018. The only other years where we got a giant change, and it was a slow, methodical change over time, and it did change our marketplace. This change is gigantic. And because of that, we're seeing a rapid change in our marketplace now that we're getting towards the middle of the year. It's slightly higher than 1994. We did a big giant change in 1994, and people, not that many people remember it. A lot of people compare this thing to 1981, but anything compared to 1981 right now, it's just scare tactics by especially a lot of YouTube bloggers. The reason for that is because if you draw a line across and of course it beats all of their years until you get to 1981. But in 1981, interest rates changed a lot more. So it was like, it's like looking at Mount Everest and it's like halfway up. That's what you're comparing it to. So you can't really compare it to 1981, although there's so many people that are comparing it because that was last time we were this high in inflation. That's the last time we were this high in interest rates. And that's how they're fighting this inflationary battle, is by these higher rates. And these are what the higher rates have done so far. It's been a giant spike. You have to zoom in to see how it's changed over like the last few weeks, which I'll do for you. But right now, that was at 5.45%. That was what we did it last week. It's at 5.55% today. And the last time we were here was June 2009 was the last time we had levels at where we're at today. So Mortgage News Daily comes out on a daily basis, gives you mortgage rates, because I was doing Freddie Mac mortgage market survey, but that came out every Thursday. And it's too big of a lag because there's way too many changes going on mortgage rates. As a matter of fact, mortgage rates can change several times a day. So it's no longer interest rates are slow to move. And that's because the Federal Reserve is completely washing their hands of it, and they're getting out of the mortgage arena. And because they're getting out of it, it has to function on its own. So there's a lot more volatility. And we were at 5.64%. You could see that. That was back in May, on May 6th. And that was the height of the year. And then we came down until we got to the end of May, where we got to 5.25%. So this is recently what happened. But then since then has actually continued to go up. And as of today, we're at 5.55% again. So that's been the change. You can see we came down and we started to come back up again. And it goes down, comes up. And that's just, this is a natural change. And people are going, what was the definitive change? And I love reading all the different articles that are made up as to why they're changing. And there really hasn't been a whole heck of a lot of news that has made this thing go up or down right now. It's just a lot of speculation. So, which tells us that right now we found a level between 5.25% and about 5.75%, where interest rates are bumping around. But because of these higher rates, I've talked about it before, as long as we have these higher rates, because we were at 3%, 3.25% at the start of the year, and now we're above 4.5%. And as long as we're above 4.5% with duration, it's going to cool down our marketplace. We've talked about it here. And the biggest thing that you see is you see the inventory climb. These are interest rates. 2013 is the dotted green line. Dotted yellow line is 2022. And you can see I actually had to modify this because today's print, because I do it every 2 weeks, every other Thursday, was actually at 5.55%. And if I was doing it on Thursdays, as you can see, this is the highest rate that we've dealt with since the start of the year. So we're going up, then down. Now we're back up again. And so because we have these higher rates, you're seeing in the middle there, that yellow solid line, that is 2022. That is what's happened with inventory so far. And you could see where we were at in 2013 with inventory, and we had interest rates that went up, but not nearly as much as they've gone up in 2022. But that big change in interest rates, even in 2013, going from 3.5% all the way up to 4.75%. That was enough to change the marketplace back then. Just like this giant change in interest rates this year is having a big change and impact on our inventory. So as a result, we've seen this inventory totally climb, and it is going up. And going up is what it's doing. You can see it right here. This is as of today. Today it's at 23,289. It's the second largest rise of the year, up 12%, or nearly 2,500 homes. That was the largest rise of the year, not the second largest. Largest rise of the year. And last year we were at 17,631. That's 24% less than where we are today. That's the red line. We're now moving away from it. As a matter of fact, as you could see in the month of April, we officially had more homes on the market than last year for the first time since 2019. So it's been a long time. Every single time we were looking at it, it was fewer and fewer homes than the prior year. But now we have more homes on the market than last year. And this is a new trend that will continue for at least the next year. So last year, almost 5,700 fewer homes. The 3-year average is 39,630, nearly 40,000 homes on the market, yet we're at 23,289. That's 70% higher than where we are today. And keep in mind that that 3-year average that I talk about is 2017, 18, and 19. That is prior to the pandemic. And remember, that was when things were normal. So we had a normal market back then, and that's what that's what the market is trying to do with these higher rates. Is now that it's slowing things down, the inventory is growing more towards a normal market. So that's 70% higher than where we are even at today. Now that was a lot. It was over double, and now that the difference is starting to dissipate over time. So it's getting less and less. And I imagine by the time we get towards the end of the year, we're going to be pretty close towards that 3-year average. And people are scratching their head going, how in the world can that be? Because remember, we went from not even right under 11,000 homes at the start of the year to 23,289. Now, if we did another 11,000 homes right now, we'd be right at about 34,000 homes, which is right where the market was at like in 2019 at the end of the year. So we'll have to see where we go from here. But this is what it's looking at its highest level since November of 2020. That's where we're at right now. And where are we going from here? It's going to continue to rise. And then normally it peaks right there, but it's going to then continue to rise, maybe not at the same clip, but we're going to equal right at about 2019 where we were prior to the pandemic. So we're going to be right back where we were when things were a much more normal market. Things weren't as frenzied or heated, and that's where it's going. Now, as far as demand is concerned, I'm going to do the same thing, and I haven't done this in a long time, so I had to actually update this. And this is 2013 versus 2018. Dotted green as interest rates of 2013, dotted yellow interest rates this year. And green, of course, is demand. That's a snapshot of the last 30 days worth of new escrow activity or new under contract activity. So we have properties that are under contract a bit more in 2013 compared to where we are today. The interest rate change was much more impactful this year than it was in 2013. So we're getting even more of a shift in demand. That's that yellow line. So you can see we're really coming down. It's a bit more muted than where it was in 2013. So that's what the cool down is that we feel. Now, understand that this demand reading is low, and we're going to get into what that is in a second, but it's not like it was during the Great Recession. It's what's happening is buyers are taking a look at how much of their monthly payment would be devoted to purchasing a home. And across the United States, this came out at the start of this week. This is Black Knight. We're now at the same level or right below where we were just entering into the Great Recession. Now, the difference is the quality of everybody that is out there that has purchased homes. Good credit, good down payments, good jobs, money in the bank. There weren't all the teaser loans, the 0% down loans, the subprime loans, FAGA mirror loans, poor credit, dead people got loans, dogs got loans. This is really true. This is where we were prior to the Great Recession. So instead, what's changing is this time around, as this becomes more unaffordable, we don't have those teaser rates. Teaser rates back then, you got these low adjustable rates, and those low adjustable rates actually enabled many buyers to buy, even though they were really low rates. They qualified on those low rates, and then they would reset. And when they reset, the homeowner couldn't afford the new amount. So that was that's where a lot of people got into a lot of trouble. This time around, we don't have any of those teaser rates, and you'll hear all this noise about adjustable rate mortgages that are starting to increase. The adjustable rate product right now is nothing like it was prior to the Great Recession. it's not even that favorable. The products aren't even that favorable if you really sit down and look and talk to a lender as to what the differences are. It's much better just to do a 30-year mortgage and then hope that interest rates come down to a point where you're able to refinance, because you're able to refinance as many times as possible. So this is where we're at right now. As far as demand, that's a snapshot of the last 30 days worth of escrow activity. Today, we're at 14,196, so it went down another 5%, or 708 pending sales. This was this was where we got the second largest drop of the year. And this is not quite what we were expecting, so it was a bit more than what I was expecting, but that's because we saw in purchase application data, it went down quite a bit within the last year, and now we're over 20% down year over year as far as purchase application data is concerned, and it just happened this week. So that means within the last week, we've seen a big change and a lot of borrowers backing off on the idea of purchasing, which goes hand in hand with the higher rates. Doesn't mean that it's stopping. It means that it's less than where we were at last year, understanding that last year was the busiest year in Southern California since 2005, selling more homes than all other years during this expansion. So now we're just coming back down to earth because interest rates are rising. And last year we were at close to a little less than 20,000 pending sales. That's 39% higher than where we are today. That's that red line versus the gold line. And 3-year average prior to the pandemic was 24% higher than where we are today, or 3,500 extra homes. So you have to understand, so there's less inventory than prior to the pandemic, and demand is down less. So now yes, there's less demand, but it's pitted against fewer homes on the market. And that's why the market still right now today is hotter than it was prior to the pandemic. And it's 9% lower than 2014. That's where we are at right now, which was the lowest level since I started tracking it in 2012. It doesn't equal back into the Great Recession days, because I only have that going back that far in the county of Orange. But this is 9% lower than 2014, or 1,439 fewer pending sales or new contracts compared to 2014. So we're a bit less than where we were in 2014. In 2014, you have to keep in mind that was when interest rates went way down in 2013. Went way up in 2013, and it slowed down our market in 2014. So now I'd like to thank our sponsor. We're sponsored by JMJ Financial, and Jason, I just want to say thank you for sponsoring us, Jason Thibodeau. You can reach him at 714-330-8263. He knows his stuff. He's been around the block. He's been doing this for a long time. And he has this program. It's an earnest money deposit insurance. It's a home buyer EMD, that's earnest money deposit. So when you put a deposit down on a home that you're purchasing, this is protecting it. And there are fees involved in doing that, but it will ensure that you get your money back. And they can do a lot of things, and even removal of loan contingencies, close in as few as 5 days. So they know what they're doing over there. And lock and shop mortgages. So, you can actually lock and shop. And even if the rate goes down, so even if rate improves, there is an option to secure a lower rate. So this is quite the program too. They have 90 and 100-day locks. That are options that are available in case you want to lock and you feel that rates are going to go higher. You can talk to Jason and his team about that. So their methodology is simple. We don't make promises we can't keep. They're going to tell you exactly what what the scenario is for you, and what's all the different programs are that best meets your needs. So Jason Thibodeau at JMJ Financial, you can reach him at 714-330-8263. That's 714-330-8263. Thanks again, Jason, for your sponsorship. We really appreciate it. Now, as far as market time is concerned, how long is it taking to place your home on the market when you're opening up escrow? That's the market time that we really care about. And the market time, I did it again. This time I had to update this, and this is the expected market time in 2013 versus 2022. And this is in a number of days on the left-hand side, and mortgage rates on the right-hand side. And you can see in 2013, we had a big change. And that was the last time that we had a really frenzied, heated market. As a matter of fact, it was the most frenzied market that I had ever seen prior to the pandemic markets of 2020, 2021, and the start of this year. And you could see that with interest rates changing in 2013, the green line, this is market time, went down from, it was at 39 days and went all the way up to over 90 days. So that put it into balanced arena by the time we got to the end of the year. Now, this time around, you can see the interest rate change is much more spectacular. It's much, much larger. And because of that, we're already seeing this big change in the market time. And the market time is changing extremely rapidly. As a matter of fact, it is a bit more rapid within the last 2 weeks than it was prior. So we actually went up an additional week. So market times are on the rise. And you can see it right here. On March 17th, we were at 24 days. That was when we had the lowest level of the year. And there were some markets like San Diego County that got all the way down to 18 days. And today we're at 49 days. That was up 7 days from 2 weeks ago. So it went from 42 to 49 days. So it's now the expectations, enter the market today, you place your home on the market, it's going to be 49 days before you open up escrow. That does not sound instant, like so many homeowners that are placing their homes on the market expect the market to behave like it did earlier this year or over the last 2 years, and it's not. This market is no longer instantaneous. Last year at this time, we were at a 27-day expected market time. That is an instantaneous market. The 3-year average prior to COVID is at 68 days. This is what I was trying to point out. We're trying to get more towards normal. As a matter of fact, because interest rates are as high as they are, it's going to go above that 3-year average by the time we get towards the end of the year. But that's okay. It's going to create more of a balanced market, one that doesn't favor buyers or sellers, one that you're going to have to, it's kumbaya. You're going to have to negotiate things to make things happen. And as a matter of fact, where we are at right now at 49 days, this is equal to where we were at the same time 2 years ago in 2020. It was when in the pandemic, when we were starting to really start to go down lower and faster and hotter and hotter and hotter. This was by the time we got to June, it was becoming a really hot market and dipped below 40 days by the time we got to July. And that, remember, anything below 40 days is insane. But we're no longer at below 40 days. We're at 49 days. So that insanity in the market is disappearing. And I forgot to do Ventura for this, so I apologize. Hopefully I can look it up right at the end and we can give you an update on what it is in Ventura. But Los Angeles went from 30 days on March 17th to 53 days. Orange County's gone from 20 to 44 days. And Riverside's gone from 21 to 46 days. San Bernardino's gone from 28 days back then all the way up to 59 days, almost below. It's above the threshold for a hot seller's market, which is 60 days. Above 60 days is a slight seller's market. San Bernardino is about to get there. They should be there by next week. San Diego's went from 18 days to 41 days, and they finally entered the no longer insane level. So they were at last time at 39 days. They're at 41 days today. So, but don't get me wrong. This is not going to be, I'm not talking about we're going to a buyer's market where values are coming down. Instead, I'm talking about a market that is much more balanced. And that's where it's moving towards, that kumbaya market where buyers and sellers need to talk to each other and figure things out. Sellers no longer get their way, but buyers don't get their way either. And sellers need to be priced right. There'll be a lot of people that are overpriced. Buyers can take advantage of that later on this year. Sellers will be unsuccessful later on this year. And price reductions, as far as price reductions are concerned, this is taken from Altos Research across the United States. It's trying to make its way really fast towards that blue line, and that blue line was 2018, and that's pretty average for where we should be. And we should be right around 30% of the entire market should be reducing their price across the United States, and we're at 24% of the entire market. So it's definitely changing from where we were last year, and that's that light pink. That was last year. And but in Los Angeles, 26% of the inventory reduced their price. In Orange County, 27%. In Riverside County, it is 30%. In San Bernardino County, it is 30%. They're back towards normal. They have like a normal market. So 30% of their market, their entire inventories have been reduced. And San Diego's at 26%, and Ventura, that should say Ventura, it says San Diego. Ventura's at 25%. So I will copy that. Give you, if you want a copy of this, I'm going to fix those couple slides, add Ventura as well. Send this to all of my subscribers. Automatically, they get a copy, but you have to be a subscriber in order to get it. So yes, you too can subscribe by going to reportsonhousing.com and click on subscribe. And we have reports that dot all over Southern California and soon to be the Bay Area. $15 per month or $150 per year. You get the first month free if you utilize the coupon code COOLING. And the most recent one that came out for San Bernardino Riverside was this week, called Affordability Challenges. You have to go back. Orange County, San Diego, and Los Angeles got theirs the week prior. So if you sign up, you get this latest report regardless of what county you're in. But San Diego, LA, and Orange County get a new one that comes out on Monday as well. And we do have free content. It's called The Scoop. You can go to the free content page at Reports on Housing, and you can download this for free. And you can see it has lots of data and information that's for free. And if you want to customize this, you can go to this on the right-hand side, and you can customize the scoop for a county. But you have to be a subscriber. And all you have to do is enter in what county you're interested in, your first name, last name, email, and then you know what? We'll know whether or not you're a subscriber. We'll reach out to you and customize it and get it done for you. But that's all I have for you. And I wish I had a lot of kids to parade around, but I am, like I said, in a secret location remotely. I'm hanging out with my mom. Anyways, we're going to go back to mom. That's why I was a little bit late. Sorry for the late entry into this housing debrief, but I hope you have a fantastic week and finish your week, and you have a wonderful weekend. Stay cool, because I understand it's going to be a hot one. It's going to be one of those weekends where you can go to the beach, go to the pool, and enjoy yourself. So enjoy yourself. We'll see you in another week. Thank you so much, and we will